Hi, welcome to the Market Alert for the 31st of May 2019, last one for May. And yes, the carnage continues. We've got cryptos lower. We've got crude oil has broken the 57 handle, as they called it, and the credit yield curve continues to collapse as well. So let's have a look at the Dow first. And that will be this one. We'll start off with the daily chart. We can see yesterday the market managing to move higher, but then overnight we've seen the market move sharply lower. I don't know the reasoning behind this. I can't seem to find any news at the moment, but it doesn't really matter. We've got a situation where the Dow and all stock markets are now under a lot of pressure. If we go to the weekly chart, you will see that the 25214 that we marked up earlier in the week has now been taken out. And the great thing about having the weekly charts and the monthly charts is it allows you to mark up where all of the next downside targets are and have them in view in one chart. And this just makes it a lot easier. So let me just save this. So this is the picture. Also, one thing to mark up here, of course, is the recent low to the recent high in the weekly chart. And this will bring you around to this area where it will be crucial. And any close below this area would then mean that the December low, when the Fed said they were not going to increase interest rates any longer, or they couldn't foresee doing this year, that allowed the market to move back to the upside. So these are the areas of support you want to have a look at. We've certainly got a movement to the downside there as well, but it's overnight where this move has happened, and we'll come to that in just a moment. Yesterday we see the market, just go back here because it was really important yesterday, and let me just bring this over so we can see that the market came through the 200 bar moving average in the overnight, and then we saw a test of this yesterday. You can see them buying back into this. Doesn't matter what the time frame is, have a look at the 200 bar moving average within that time frame and you will see how the market loves this area. So we saw some buying off the DP level as well. Initially we got the 3 professional buying bars there. The market ran out of momentum, came back to the 20 bar moving average. Then we had a double top here, sell signal, and the market moved lower 100 points, bounced back 50% of this, and then went back and put in a triple top with, again, you can see you've got an upthrust here. Indecision, the market going up on fresh air, and then the market makes its way back down once more. And then we get the plunge boys coming in just to bring the market back there. You can see the buying coming in here, and then we have the buy signal, and then the market moving higher. We've got a 76% retracement by the looks of things here. If I just draw this in from the high down to this low, you will see 76% across there, and the market holding. And then overnight, as I say, I've not really had a look, don't really need to because the chart says it all. The market's closed dramatically through both the 200 bar moving average and the DP level, down 200 points on the overnight. This is a serious move there, and the market currently sideways. So keep an eye on this on the intraday and also on the electronic market, the pre-market session, because something's stirring here. And also keep in mind these bigger targets as well. 24884 is the next downside target for this market. Any news today? Nothing. Nope, absolutely no news there. It's all medium impact. And we can actually remove this option from the software actually, because we're not seeing any movement off the economic news, so we'll remove all of the medium impact ones and then save that so that they're off the chart there. And meanwhile in the pound, not doing a lot. Still some downside pressure because of the uncertainty down in Westminster with regards to who's actually in charge these days. So, but not selling off. And yesterday I received a comment on the YouTube channel saying about, why aren't the markets in free fall? And it's a very good question. I mean, obviously central banks are supporting what's going on at the moment. They've been manipulating the markets now for the last 10 years and holding markets with the use of derivatives. And no surprise, really, there's no fair market or fair price anymore. Well, not at the moment anyway. That may be a different ball game once things start to fall apart and people decide to actually get out, and they get out in larger numbers. Then it'll be interesting to see how the high frequency trading algorithms cope with it when they all turn to the sell side. It'd be carnage is what it would be. So we'll see, but not a lot to report there. You can see it's a narrow range. You can't even see the psychological levels. There you go. You can see how much it's moved, not a fat lot. So the pound not really of that much interest at the moment. Meanwhile, Bitcoin, this is a classic top area for a market, so do expect some profit taking. The market came down to the 76% retracement, managed to climb back above it, but I'd be very surprised not to see this market retrace given what we're seeing here. So certainly some selling, and it took place on the overnight. As you can see in the 4-hour chart there, it was a quick mark to the downside, as it states here. Crypto crash accelerates, Bitcoin plunged to 8,000. And we can see that down, it was actually down to 7,945 at one point. And then intraday, you will see the market moving higher, and then all of a sudden we had this sell come into the market. We had a high at this point. It's a high that we have not seen for a long time. The high coming in at just under 9,894.0, volume very high, and then we see the market being pulled back at the 200 bar moving average, but then once it closed, it then accelerated through the evening. So we got profit taking starting here, and then the selling really took place in the overnight, but there's been some profit taking and buying back here. Watch the 200 bar moving average. If prices manage to make its way up to here and they close back through, then it's likely you will see the market move back to the downside there. So we'll keep an eye on that one today, but nice bit of volatility there for this market. So just to finish off then, let's have a look at Deutsche Bank. Yesterday down to, let's just scroll this up, we should have some figures here somewhere. Previous close volume range yesterday, that's what I was after, 684, 695. So once again lower, but managing to, you can see there, come off these lows. Again, we'll keep an eye on that 640 level. The implied volatility 1655 the day before, 1595. This is going to explode to the upside unless they can bring the stock market back up rapidly during today's main event. But otherwise, you're going to see this continue to increase, which is fine. That's consistent. And finally, as I said yesterday, I was looking for a yield chart that is actually updated daily, and it's very difficult to find. This one goes back to Wednesday. This is the Fed one. This comes out of the Federal Reserve. We can see there, if I just move the mouse pointer, there is a little bit down there where you can see that the 0.12, so it's definitely way below the yield curve now. And when you look at the max chart, it can go through quite a bit. We've got a long way to go yet compared to the previous drops as we see here. So the yield curve continuing to move to the downside. However, just to finish off, if we have a look at this chart, this is a dynamic one. This one is up to date and fascinating because we can go back and actually have a look at this. I've shown you this before, but again, just to emphasize the inversion of the yield curve, the 3-month over the 10-month, where the stock market eventually will fall. So if we go back here, we've got the dot-com bubble 2000, we've got the crash of 2009, and then we'll look at the current one. And if we scroll here, we can see, if we've got to look down at the bottom here, we've got the 3-month and the 10-year. And if we just scroll across, if we watch the left-hand side part of the charts, it's amazing, isn't it? Look how high interest rates were. Well, they didn't seem that high, but they are by comparison today. Back in 2000, you'll see on the left-hand side part of the chart how the yield curve becomes inverted as we move here. And you can see just there now, I'll just hold that there, and you'll see the 3-month is higher than the 10-year. And then everything back to normal until we get to around here. You'll see, I'll just bring it back a bit. It's always difficult to do this. There you go. You've got the 3-month again higher than the 10-year before the 2008 crash. And then as we scroll across here, you can see how the rates are now. The 2.32 is obviously the 30-year that you're seeing here as well. We know that the bank rates aren't that high. And again, if you watch the, there you go, you can now see that we have an inversion of the 3-month higher than the 10-year. So it's based upon this and the repeatable pattern, unless there is some sort of intervention by the central banks. But normally, as we've seen in this chart, that the inversion of a yield curve is a precursor to a recession. And that's where we currently are now. It doesn't happen straight away. It also sees the stock market move lower, and it's usually within 18 months of this occurring. So it could be faster, given the huge amounts of debt that we see in the markets as well at the moment. And of course also the global slowdown and other uncertainties as well. Okay, that will do it for this one. I just thought I'd give you a heads up there, give you the background of what's coming down the line. And yeah, have a great weekend. As ever, thanks for watching. See you in the next one.